January 29th, 2026. $3.4 trillion gone in 55 minutes. Not in a day, not in a week. In the time it takes to drink your morning coffee, the largest safe haven asset on Earth lost more value than the entire GDP of France. Roughly $60 billion per minute evaporating in real time. And then 2.3 trillion flooded back in before the closing bell. Gold, the asset that's supposed to be stable, boring, the anchor of the financial system, just moved like a penny stock. And while it was happening, three of the most powerful banks in the world published price targets that would have been laughed out of the room 6 months ago. Goldman Sachs, Deutsche Bank, JP Morgan calling $6,000, $8,000, $8,500. Targets rising by thousands within 72 hours of each other. Something broke on Wednesday, and what comes next will separate those who understand what just happened from those who think this was just another dip. Let's go. Gold hit $5,600 per ounce Wednesday morning, peak safe haven, peak certainty. Then 9:30 a.m. Eastern hit and 8.7% was gone in less than an hour. $5,100, $3.4 trillion in market cap deleted. This wasn't retail panic. This wasn't weak hands folding. This was institutional desks getting margin calls and liquidating their winners to cover their losers. Microsoft down 12%, equities imploding, volatility spiking. And when that happens, you don't sell what's bleeding, you sell what's profitable. Gold was up 90% year over year, so gold got executed. But here's what nobody's talking about. Here's what separates this crash from every other one we've studied. It recovered the same day. Not in 3 years like 2008, not in 6 months like March 2020, in 6.5 hours. By 4 p.m., $2 trillion had poured back into gold. The liquidation got absorbed. The market reversed, the dip got bought with institutional scale capital. That's not a market rolling over. That's a market so hungry for gold that forced selling gets instantly swallowed. And that's when the bank started revising. January 27th, Deutsche Bank calls $6,000 per ounce by end of 2026. January 28th, JP Morgan analyst Nikolaos Panagiourtsoglou puts out $8,000 to $8,500. Goldman Sachs had just called $5,400 1 week earlier. Already exceeded, already obsolete. These aren't Fringe analysts. This is Goldman Sachs, Deutsche Bank, JP Morgan, the three largest investment banks on the planet revising their gold outlook upward by thousands of dollars in 72 hours. They're not leading the market, they're chasing it. And the thesis they're all converging on is portfolio reallocation. Right now, private investors hold about 3% of their portfolios in gold. JP Morgan's model says, if that shifts to 4.6%, just 1.6 percentage points higher, you're looking at over $3 trillion of incremental demand flowing into a $40 trillion market. $3 trillion into a market that just lost and regained $2 trillion in a single session. What happens when that capital wave actually hits? What happens when institutions start executing that reallocation at scale? The answer is in the price action, and the price action is telling you the system can't handle what's coming. Now let's talk about the numbers you're seeing everywhere, because some of them are accurate, and some of them are mathematical theater. 58 billion per minute is technically true if you divide 3.2 trillion by 55 minutes. But the actual loss reported by exchanges was 3.4 trillion. That's a $200 billion rounding error being smoothed over to make the headline cleaner. 850 billion per hour during the recovery is flat wrong. 2.3 trillion over 5.5 hours is 418 billion per hour, not 850 billion. That's almost double the real number going viral as fact. Does that change the thesis? No. But it tells you the narrative is running hot, and when narratives run ahead of data, that's when retail gets wrecked. Here's what the data actually shows. Gold crashed 8.7%. Violent, yes, unprecedented, not even close. 2008 saw gold fall 28% during the financial crisis before rallying 150%. March 2020 had a 12% crash before central banks printed and gold hit all-time highs. Wednesday was 8.7%, then full recovery within hours. This wasn't capitulation, this was liquidation. And liquidation followed by immediate recovery is one of the most bullish patterns you can see in a structural bull market. But it's also a warning because the next wave could be worse. Strip away the hype and here's what remains. Central banks are accumulating gold faster than at any point in modern history. China, Russia, India, Turkey, Poland. official reserve data, verified purchases, not speculation. Safe haven demand is structurally elevated because long-duration treasury bonds, the traditional flight to quality trade, are losing credibility. Deficits exploding, debt to GDP at record highs, inflation expectations persistent. That's the macro reality, and it's accelerating. JP Morgan's 8,500 target is built on one assumption, that private investors increase gold allocation from 3 to 4.6%. That's the model. And if global investable assets are around 200 trillion, that's 3.2 trillion in new demand hitting a market with a $40 trillion cap. That's an 8% demand shock into a system that just demonstrated extreme fragility. Now ask yourself what happens when that 3 trillion tries to enter over the next 12 to 18 months. The answer is what you saw Wednesday, except bigger. Wednesday wasn't a gold bull giving up, it was forced liquidation across institutional books. Equities crater, margin calls hit, desks need cash. They don't dump their losses, they liquidate profitable positions. Gold was the most profitable major asset of 2025, so it got sold. Same playbook as 2008, same playbook as March 2020, but here's the difference. In 2008, it took 3 years for gold to recover and rally. In March 2020, it took months. This time, it took hours. That tells you everything about the underlying demand. When 3 trillion gets wiped out and 2 trillion rushes back in before the closing bell, you're not watching distribution, you're watching accumulation disguised as chaos. The market absorbed a liquidation event that would have crashed gold 20% in prior cycles, and it recovered the same day. That's not bearish, but it's also not safe, because if this happens again, and it will, gold could drop another $1,000 before the next leg higher. The path to 8,500, if it happens, will not be smooth. It will be violent, choppy, and full of liquidation traps that destroy over-leveraged traders. The question isn't if gold goes higher, the question is whether you can survive the volatility to get there. So what are we actually watching here? Is this a correction within a bull market, or are we witnessing a $40 trillion asset class starting to trade like a speculative instrument because the system itself is fracturing? Because that's the real question. Gold is supposed to be the anchor, the stable asset, the boring safe haven, and it just moved roughly 60 billion per minute. That tells you either the pricing mechanism is breaking under the weight of leverage and positioning, or capital is rotating so fast that even the largest markets in the world can't absorb the flow without violent dislocations. My read is both. The stress is real, the liquidation was real, but the recovery was also real. And the drivers, central bank accumulation, safe haven flows, portfolio reallocation, are all accelerating. Goldman's 5,400 target got blown through in a week. Deutsche's 6,000 is within reach. JP Morgan's 8,500 requires 3 trillion in demand, hitting a market that just proved it can swing 2 trillion in hours. Is that possible? Yes. Is it guaranteed? No. But here's what I'm watching. If gold holds above 5,000 on the next wave of selling, that's a higher low and the bull case stays intact. If we break below 4,800, we're likely heading to 42 to 4,500 before the next leg up. The targets from Deutsche and JP Morgan assume no major liquidity crisis. They assume continued central bank accumulation. They assume the bond market keeps losing credibility. Those are reasonable baseline assumptions, but they're still assumptions, and assumptions break during crises. $3.4 trillion evaporated in less than an hour, then 2 trillion flooded back in. That's not normal price discovery. That's a market in transition. The banks are revising targets higher by thousands of dollars within 72 hours because the fundamentals keep outpacing the models. For long-term holders, the structural case is intact. Central banks are buying. Safe haven flows are real. The bond market is losing credibility. For traders, this environment will destroy leverage. The swings are too fast. The liquidation's too violent. And for everyone else, understand what you're watching. This isn't hype. This isn't a pump. This is a $40 trillion asset class moving like a speculative instrument because the system itself is under stress. The question isn't whether gold goes higher. The question is whether the path looks like a steady climb or a series of violent liquidations followed by explosive rallies. Based on Wednesday, it's the latter. Position accordingly.